I mean, I'm going to talk really more about the big loan books because that's what I'd mostly get involved in. I mean, I think, 2 years ago, may have been 3 years ago, West Immo tried to sell a big German loan book, and you basically couldn't give it away. There was, Apollo were meant to be buying it, but in the end, the deal never closed. So there was literally no interest. And if you'd told me a year ago that Eurohypo's, whatever they call themselves now, sorry, Nicholas, Hypothek and Bank Frankfurt, were going to sell their London performing and non-performing loan book, and you'd get 5 fully funded bids for that book, I would have laughed, frankly. And here we are today, and that's happened. And so I think that I think the pricing of that was attractive for Commerzbank. So I think where we are is there's some sort of unsatisfied demand from buyers of that book, which has probably led Deutsche Bank to put Postbank's London book on the market. There are rumours that there's another UK loan book from a German bank on the market right now. So there's a lot more interest in these loan books, and they're coming. I think the second factor is what I referenced in my opening remarks, the American wave. I think there's a lot of corporate distressed ARB funds in the US that have raised a lot of money. We know some of them, Oaktree, Vardé, Oxzif, but there's a whole list of new names coming who have raised money for American corporate distress, which ain't happening anymore. America's in better shape. So they've got money, they've raised capital, they've got LPs who are interested in doing deals. Schwartzman of Blackstone stood up in America about 4 or 5 months ago saying, Europe's where we're going to play. And if Blackstone say that, people get interested. So there's a lot of stuff. There's a lot of people coming. Key question then is, can they find deals? But I think what that means for pricing, for vendors of loan books, it's good news. There's a lot of appetite now for these deals. Ireland, Spain, is going to come. Germany might start to come. So let's hope that the buyers can find some sellers.
Just on the German side, I think one of the complications on the West Immo thing was that no one felt they could replicate the cost of funds of the fan refinancing, and therefore they'd inherit a different cost base if they acquired those loans. But we had an involvement in the Eurohypo portfolio at one stage. I think one of the problems was that they weren't willing, because they were performing loans, they weren't willing to accept a write-down of value, even though the margins were historic. So on a sort of return perspective, they weren't worth the full par value of the loan, but they just wouldn't willing to accept a reduction to reflect that. But I think now, because of the state aid requirement to disposal of this, moved on slightly from that.
That's changing. We're working on a few it's not non-performing, it's sub-performing as a new header we've put on it. So LTVs are sort of 75 to 90% pools. And I think as banks are now much more focused on the cost of capital attached to holding these loans, actually we found them at least willing to enter into conversations and entertaining bids at a discount to par. Clearly, you're not talking, Irish discount to par of 70%. You're talking, high 80s, early 90s. I think in a number of ways, actually, this part of the market is a very interesting space where less people are chasing, because it is people that have return requirements in high single digits, very low double digits, which I think is perhaps a less crowded space. But I'll echo Jos. I think in terms of the general appetite for loans, a few observations. One, the US definitely, we're seeing Asia coming in quite strongly. We were talking before this panel started about some of the Japanese funds starting to look at yields, thinking I'm getting 1%. I'm getting 1% in Japan. Actually, 6% sounds really sexy. So I really have a crack at this, even for the performing pools. And even, I think, the more traditional pockets of money in the UK, including the pension funds, are selectively looking at some of these situations. They're not the one that are going to end up bidding for the next Project Thames or the situation in Ireland, which is quite granular and quite resource intensive. But would they look at, a single asset situation where there's one big loan attached to it? Absolutely. And we've worked up a few situations for them. So I think that market is getting deeper as well as broader. And I never cease to be amazed by the level of interest you have on that. I think if you put the same properties on the block, interestingly, because some of them are tertiary, to be polite. Frankly, I don't think you'll have bidders for it if it was a property. For the loans, there are people out there because it's a slightly different model of churning, and there's a lot of capital chasing that.
And I think the performing loan market is actually quite an important market as well. A number of sort of institutions are looking at that, including those who are looking to get into the loan market as a way of getting scale straight away. And I mean, what happened on your hypo was quite interesting, the way the portfolio was effectively broken down on a JV basis between an entity trying to acquire performing loans and an entity acquiring non-performing loans or loans that didn't meet certain criteria in terms of diversifying the sources and optimising pricing.
But I think there's a health warning with, and people in the room will know, there's a health warning with the NPL sector. I mean, what I'd love to know is how have these early deals performed for the buyers? You know, I suppose some of the deals were done 2, maybe 3 years ago. Secondly, the good assets tend to trade out pretty quickly, so almost immediately when the loan deal is closed. So, but there's a lot of secondary and tertiary property that remains in the hands of the loan buyers. And then thirdly, these portfolios are often starved of capex. They're in structures that are typically stressed. There's often, claims, other creditors, inter-creditor agreements, issues in the structures, particularly in Europe, which makes it pretty difficult to get out of them your sort of blended underwriting when you went in. So, I think for some of the earlier buyers, the rumours in the market are they're not going as well as they'd hoped.
I think the banks have been quite clever in sort of leveraging off the competition amongst private equity funds which have very similar business plans, and relative to the capital looking at that space, there haven't been that many portfolios on the market. And as I understand it, Lloyds on some of the deals have actually written back profits because the prices have exceeded the amount by which they previously impaired the loans. And originally I think the guys thought they could do like a so-called wholesale to retail, but I think that's a lot harder to implement in practice, and they have to do a lot of the asset management themselves. So although they have the easy gains initially, as much as there's a big tail there.
Though, let's be clear, I think if anybody can make money out of these loans, the guys that have bought them early in the cycle. It doesn't get much more capable, some of the names that bought it. So I'm frankly not worried about it. I'm more worried about people that are buying loans, they're just buying into it because it seems it's a new way to property and don't understand actually it's not the same. I'm more worried about that part of the market than the guys that are professional loan buyers. To pick up on your point before you ask the other question is, there's no doubt banks are writing back some of their positions. On the DPO situations where we're acting for borrowers bringing new capital to make a discounted offer, we know for a fact that the reason why our offers were taken, it was because we were above, we hope only slightly, the provision level of the banks. And that comes down to this information asymmetry. I think that the banks think they have a valuation from a big surveyor firm, which is just drive by the property and don't really know the situation, as well as a borrower, and say, well, that's worth 50. And the borrower is like, well, actually, I have a tenant in there that's going to move tomorrow, and that'll be worth 70, so why don't we offer 52? And there are proper money to be made there. The challenge is really tracking this market and managing, frankly, the ego of the incumbent and having the conversation about the dilution. That's really they are the real big blockers, finding them and then having an intelligent conversation. There are a lot of very clever guys out there, but clever guys that recognize they need help and recognize they need external capital and are prepared to agree a suitable deal to do that. It takes a fair amount of effort.
One area where we've seen that sort of arbitrage is where you've got an asset generating sort of EBITDA-related cash flow, which may be like an operating asset, where the borrower believes that the bank is undervalued, doesn't understand the cash flow, and has undervalued the asset, and that may be because of the nature of the cash flow, or it may be because the valuers are scared of being sued, have come up with a too low figure. And therefore, they believe that using that as a benchmark of pricing, they're actually buying in, you negotiate against that value, obviously leverage off it to whatever basis you buy the loan in, but you've already got an accretion in value through that sort of implicit mispricing.
And I think, managing the ego of the incumbent owner or manager is interesting. I think what we're seeing is banks since probably sort of summer of last year, are getting a bit more ballsy, for want of a better word, at actually having quite difficult and tough conversations with the guys with the egos, and are now changing or transitioning them off mandates or out of situations and replacing them. And that's definitely happening now, where it really wasn't happening for 3 years post Lehman going bust.
So there was that element of sort of regulatory arbitrage where it's becoming more difficult for the banks not to write down the loans from a capital perspective, with some banks being required to sort of effectively introduce slotting on an accelerated basis. So there's that sort of arbitrage where purchasers are not subject to those constraints.